And with that, I'm going to introduce the keynote speakers. We have two this morning. One is going to be joining us by Skype, and one is here with us on the BVC stage. Brad Feld is our keynote speaker joining us by Skype. Brad is the co-founder of the Foundry Group and Techstars. Brad's been an early-stage investor and entrepreneur for over 20 years. He lives in Boulder, Colorado, and Homer, Alaska with his wife, and is on a quest to run a marathon in every state in the U.S. Brad has been an early-stage investor and entrepreneur since 1987. Prior to co-founding the Foundry Group, he co-founded Mobius Venture Capital, and prior to that, founded Intensity Ventures. Brad is also a co-founder of Techstars. In addition to his investing efforts, Brad is active with several nonprofit organizations. He currently is the chair of the National Center for Women in Information Technology and the Global EIR Coalition, and is on the boards of Path Forward and the Kauffman Fellows and Defy Ventures. He's a writer and speaker on the topics of venture capital investing and entrepreneurship. He's written a number of books as a part of the Startup Revolution series and writes the blogs Feld Thoughts and Venture Deals. Brad holds a Bachelor of Science and Master of Science degrees in Management Science from the Massachusetts Institute of Technology. He's also an art collector and long-distance runner, and he's completed 25 of those marathons that he plans to run in each of the 50 states. We also have with us today Aviel Ginzburg. Aviel is going to be here present with us on the BVC stage. He is a Seattle-based investor and a recovering entrepreneur. He's the managing director of Alexa Accelerator, powered by Techstars, a venture partner at Founders Co-op, and a co-founder of Simply Measured. Prior to investing professionally, he dabbled in angel investing with a portfolio that includes Seattle Breakouts Outreach and Glowforge. Aviel got his start in tech working as a software engineer at Aperture in Seattle, an early email marketing automation company that went on to sell to IMS Health in a 9-figure acquisition. Prior to that, he, for some reason, used his BS from Vanderbilt University to pursue a career in New York City as a cinematographer. Please join us in welcoming Aviel Ginzburg to the stage and Brad Feld on Skype. Thank you.
Thank you. Thanks so much.
Thank you. Nice to see you.
Yeah.
Glad to have you.
Oh. All right, see if I can get up in this chair. Let's make sure all the audio is working. Brad, can we hear you? Give us a shout.
I can hear you guys fine, and I see a great audience full of people in what looks like a beautiful theater.
Awesome. Great. Well, so this is actually my first time.
And now I see a very, very, very big head of mine on stage.
All right, so this is actually my first time in Bend, and there was one thing that really stood out as I was walking along the streets, and that was, minus the flat irons missing, this reminds me a lot of Boulder. But there's obviously some other aspects that are missing. For instance, the vibrant tech scene and startup scene that exists in Boulder. And I'd love to kick us off with a question to Brad saying, what were, in the early days of the tech startup scene in Boulder, what were some of those critical things that happened in moments that helped kind of kickstart that ecosystem?
So I moved to Boulder 21 years ago from Boston. My wife, Amy, and I met in school and lived in Boston for 12 years. She grew up in Alaska, and I grew up in Dallas, Texas. So Boston wasn't home. And when we moved out to Boulder, we knew one person, and he moved away 6 months later. So we moved to Boulder because we chose a place to live. It's important to know that the reason that we moved to Boulder was about 2 months before I turned 30, Amy told me she was moving to Boulder and I could come with her if I wanted to. And we've been married for about 5 years. So it was really one of those life choices rather than something else. Within a year or two, so this is the mid-90s, I started looking for other entrepreneurs, other friends of mine. I was investing as an angel investor. I was CTO of the company that had acquired mine and had really shifted into a staff job versus a line job and was spending a lot of my time all around the U.S., East Coast and West Coast, making investments. So when I moved to Boulder, I really had no expectation of any investing activity. Within a year or two, I found 15 or 20 other entrepreneurs in Boulder who, in the mid-90s, were active, running their companies, building their companies. I also started to get to know the nascent ecosystem in Boulder, which included a handful of venture capital firms, a couple of law firms. And the dynamics were very interesting, is that there were almost two separate universes. By the way, there's a University of Boulder or University of Colorado at Boulder, which is the largest university in Boulder as well. And the dynamics that we had at that point in time, there were kind of these two categories. One category were a set of people who I would categorize as well-intentioned, but behaving like gatekeepers. The VCs were particularly egregious in this dimension, which is that they basically would say to anybody that would listen, we know all the entrepreneurs here in Boulder, and we choose the best ones, and those are the ones we invest in. And of course, there were, I think, 3 or 4 venture firms at the time. And the entrepreneurs aren't stupid. They knew who the 3 venture firms were. So all the 3 venture firms saw every one of the entrepreneurs. And if you actually looked at those 3 venture firms, they were investing in different things. So the idea that they were effective gatekeepers didn't really make much sense. And if you look at the next generation of entrepreneurs, the people who were probably in their, age is not the right category. Let's say the first company that they were working on versus they'd been involved in 2 or 3 companies over the years. Those entrepreneurs generally were not necessarily looking towards those VCs and gatekeepers. And by the way, the lawyers played a gatekeeper role, and the university was playing a gatekeeper role. When I wind the clock forward to today, of those 15 or so people, almost all of them are still active in the Boulder startup community. Most of them are entrepreneurs. Some of them are angel investors, sit on boards, have had a successful company and are semi-retired. But they're all still actively involved in leadership roles around Boulder and the Boulder startup scene. In addition, if you look at it today, again, 21 years later, there's probably 150 to 200 people in Boulder that I would categorize as leaders of the Boulder startup scene that are also entrepreneurs and have been entrepreneurs through this period of time. Now, there's a number of other organizations that, if you've read my book, Startup Communities, I refer to as feeders, which are just as important, by the way, as the leaders, but they play a very different role. And these feeders are the university, local government, some nonprofits, law firms, et cetera. And while some of those people are the same, many of them have changed over time. They're different people in different roles. And people come to the university in whether it's academic positions or administrative positions and get involved and then go into a different university in a different place. So the real essence of this question is, when I think about this line over this 21 years, the key is that there is a critical mass of entrepreneurs who in the mid-90s were playing leadership roles in the Boulder startup community, that 21 years later are still playing leadership roles, but are not controlling the Boulder startup community. They're just part of a very broad set of people who were able to get involved or actively got involved and today play leadership roles. Last comment on that, it's really important to note that the 200 people in the Boulder startup community today that are playing leadership roles, nobody appointed them, right? There's no vice president of membership, and there's no president of the Boulder startup community, and no vice president of education, and no CFO. You have this very messy network of entrepreneurs who are all actively engaging continuously in the startup community. And it's created this incredibly vibrant and robust base that startups build upon.
So to kind of dig into that a little bit more, in a lot of these emerging markets, we'll hear from entrepreneurs, well, what's holding us back is a lack of capital within our ecosystem. And then you'll hear with folks who are looking to actually deploy capital within their ecosystem, they're going to say, well, what's holding us back is a lack of great entrepreneurs and places to actually deploy this. And you kind of see that as a common thread. I remember in the Seattle's obviously a much larger city, but as you go back 10 years, the startup scene was still pretty nascent, and that was something that was very common. And Brad, I'm curious, how do you kind of see the sort of coexistence and evolution? It's almost a chicken and an egg problem between the capital and the entrepreneurs, and how did that play out in Boulder?
Yeah, I'll start by saying that each of the statements is nonsense. I categorize each of those statements as an excuse, not a fact. And I'll start by asking a question. Think about Bend, and either raise your hand or don't raise your hand. Raise your hand is yes to this question, but don't raise your hand is no. Are there any wealthy people in Bend? Now, come on, raise your hand for real if the answer is yes. Yeah, of course there are. Does Bend have people who have local philanthropic intent with their wealth? And as a result, you have a bunch of art scenes and or education and or other cultural or recreational activities that are funded by the wealthy citizens of Bend. Yes or no? Yes, raise your hands. You better raise your hands, because otherwise Bend would probably suck if you didn't have any of those things. And the statement at the beginning that Bend was like Boulder, I would have to challenge, right? So let's start from that perspective. And the entrepreneurs who say there's no money here are not doing the work. There's a lot of money in your city. Almost, not every city, by the way, is a wealthy city, but even cities that are in immense decline, like, for example, Detroit, which no longer is in immense decline. I think it's bottomed out and is starting to have a lot of interesting things happen, have very, very wealthy people who care about their city and are willing to invest in their city. I'm going to get to their responsibility in a sec, but the responsibility of the entrepreneurs is to help those people understand how to invest in startups. And for an investor, the key to recognize is that it's in some ways on the downside no different than your philanthropic activity. If you believe in the long-term health of your city, the first premise you have to buy is that, or agree to, is that the innovative and economic health of your city is important. And if you buy that premise, and I'm going to believe that everybody in the room buys that premise, because you wouldn't be in this room if you didn't, then it's your responsibility as citizens of the community to use your resources, and for the wealthy citizens of the community to use your resources to invest in the long-term innovative characteristics of your community and the long-term health of your community, so that there's economic vibrancy, in the same way that you invest in the arts, in the same way that you invest in education, in the same way you invest in environmental organizations, in the same way that you invest in mental health and human services activities. Now, this is really important to understand. Investing in a startup, the downside characteristic looks exactly the same as a philanthropic gift. You get the same tax write-off. So in your downside case, investing in a startup and losing your money is exactly the same as if you gave a charitable contribution to the museum. The upside case, you can make 10 times your money, 100 times your money. So you actually have an upside case that doesn't exist in the philanthropic world, and the downside case has the same characteristics. And the behavioral dynamic is that you're investing in the innovative health of your city over the long term. So when people say there are no entrepreneurs here, the responsibility of the entrepreneurs is to teach people how to be effective angel and seed investors. The responsibility of the people in the community that want to see there be a vibrant and healthy economic and innovative economy is that they have to invest in helping the entrepreneurs learn and grow. If you look at those 15 or so leaders from the 1990s that I knew, many of their first companies or the companies they were working on in that time frame failed. A few of them were successful, some of them failed. Many of those entrepreneurs are now on company number 3. Or company number 2 was a success, and they started being active angel investors with some of the money that they made. And so it's a long-term game. It's not pick the best entrepreneur, and that's the thing you're investing in as a seed or angel investor. It's pick entrepreneurs that you believe are obsessed about what they're trying to do and want to build companies in Bend, and that you have affinity for. So this notion that there's not enough entrepreneurs in any geography where there's entrepreneurs running around trying to raise money is just nonsensical. And my suggestion is you eliminate, as an investor, you eliminate the word best from your language, because as a seed investor, you can't figure that out, right? My experience, I've made seed investments in 200 companies. At the beginning, every company I invested in I thought could be successful. I never invested in anything I thought was a piece of garbage or a founder I didn't like or thought was somebody that didn't share my value systems. But of the companies that were successful, I thought they were all going to be successful. And of the angel investments that I've had that have returned 100 or 200 times my money, well, I couldn't have told you that that was the one that was going to be that at the beginning. So this notion that as an early stage seed investor, you're picking based on that is, again, nonsense. So link those two sides of the equation. And if you're an entrepreneur in the audience, work hard at building and teaching wealthy people in your community how to invest. And if you're a wealthy person in the community, decide whether or not you believe that innovation and a healthy, vibrant economy is important long-term, not over a year or two, but over 20 or 40 or 100 years for your city. And if so, invest some of your philanthropic time and energy into that, knowing that you could have a meaningful return that will give you more money to reinvest back in that.
So to kind of build on top of that, I think those are clear paths forward for how folks can work together to help kickstart an ecosystem. But then there's also programs and things that do bring those individuals together. Techstars as a perfect example of that. And I'm curious, the first Techstars that ran in Boulder, how that kind of acted as a catalyst to help make all of that happen.
So we started Techstars in 2006 and ran the first Techstars Boulder program in 2007. If you time travel back in time, the financial crisis started in 2007 and really accelerated in 2007 to 2010 was a pretty rough time for the global economy. From a perspective of startups and entrepreneurial activity, that was a period of time that ended up being amazing for new startups. A number of companies today that are very, very significant businesses were either funded in that time period or were relatively young companies that were on a very steep growth curve during that time period. So starting point is to disconnect the macro cycles from the entrepreneurial activity. The second is when we started Techstars, David Cohen's premise, David's one of the founders and the co-CEO, he was making angel investments, and his premise was that he was really unhappy with how he was making angel investments. He was doing them, $25 or $50 or $100,000 at a time, and sometimes the founders would engage with him, and other times they wouldn't. And he didn't really know any of the other investors, and he wasn't that well connected around Boulder at the time, partly because of his own history. He had run a company for many years and was pretty heads down. But the other was he was an introvert. He was trying to figure out how to break into the scene, but didn't really have a way to do it where every time he'd go to, events, he felt like there was a lot of events where there was a lot of talk and no action. We had an angel group that I think had 300 members, and I think they did one angel investment a year. And they basically, as far as I would describe them, they basically just tortured entrepreneurs. That was their goal as an angel group. And I think they derived immense pleasure from torturing entrepreneurs. And so the premise was, let's fund 10 or so companies. Let's get a group of people together. Let's fund 10 or so companies. Let's have them go through this accelerator thing, which was just getting invented at the time, right? Y Combinator had run an accelerator program or two, but the idea was just in its very infancy. Techstars was the second organization to do an accelerator. It's very distinctly different than an incubator. Let's get a bunch of people, 20, 30 entrepreneurs to Boulder for the summer. Worst cases, we'll make some new friends. Let's surround them by mentors. So we'll give the 30, 40, 50 local entrepreneurs a reason to engage all summer long with something rather than just show up for the annual Boulder Entrepreneur of the Year award party, which is 3 or 4 hours long, and people get some awards, and it's very uncomfortable and stiff feeling for people, but it makes the organization that puts it on feel good, and then nobody engages with each other after that. Let's do that and see what happens. And what happened was remarkable. There were about 50 mentors, of which about 30 were from Boulder and 20 were from around the country. The mentor characteristics essentially in that first year were that they were all people that were friends of mine, people I knew that I had worked with either in Boulder or otherwise. And they actively engaged, some of them as much as half time because they were in between companies. Others came out for a day or two from the West Coast or the East Coast. Some of them showed up every week and got involved with one particular company or two companies. And just the energy around the entrepreneurial activity in Boulder during that 90-day period was mind-blowing. It was literally like, there was already plenty of activity in Boulder and stuff going on, but it was diffuse and it wasn't focused and it was very controlled feeling or contrived feeling. And all of a sudden there was this just an organic activity in the middle of downtown Boulder with, these entrepreneurs, by the way, 80% who weren't from Colorado, almost all of who stayed in Boulder afterwards, whether or not their companies got funded. And we realized, that we had something that was really transformative around the dynamics of a startup community, which, by the way, that phrase, startup communities, didn't exist till about 2012 when I wrote the book Startup Community. So we didn't really have any idea in 2007 what we were really trying to do. We just ran an experiment. And if we reflect on that experiment today, Techstars has now launched over 30 programs around the world that they do each year. We've got, I think, 35 already that are lined up for 2018. Some of them, like the Techstars Seattle program, are geographically based in Seattle. Others, like the Alexa Accelerator, are linked to a specific large company in their ecosystem. All of these programs, which are now worldwide, and we have 4 programs in Berlin, for example. I think we have 2 programs, maybe 3 in London. We have a program in Tel Aviv. We have an unannounced program, for example, in Singapore. Lots and lots throughout the U.S. Last week I was at Atlanta, Techstars Atlanta Demo Day and Techstars Kansas City Demo Day. Techstars Atlanta, by the way, Atlanta's another story like Seattle that 10 years ago was pretty nascent feeling. Had entrepreneurial activity, had a long history of entrepreneurial activity, but not a startup community that was vibrant. Today it's just off the charts. I spent 2 days there, Techstars Day, and then Atlanta had their annual Atlanta Venture Conference. I think there were 1,000 people there from the Southeast. Just an incredible level of investing activity, investors and entrepreneurs engaging with each other that a decade ago was non-existent. And when I reflect on it, in addition to those things happening in all these geographies, you also have this connectivity between geographies. So I love that the idea that Bend got characteristics similar to Boulder. I have several friends that are in Bend. They encourage me to come to Bend all the time. For those of you that know me, know that I traveled almost nonstop for 20-something years and decided about 4 years ago to stop traveling. So I travel very selectively now. But I do like Seattle, and I do have a place in Alaska, so it would be logical for me to some point swing through Bend. The fact that I've connected with y'all here today would make that more interesting to me. If any of you engage with me, not necessarily, hey, Brad, I have an investment, will you do it? But, hey, Brad, here's some thoughts that I have in response to what you said, or hey, Brad, here's some things that we're doing in Bend that you might be interested in. By the way, my email is brad@feld.com, so that's a super easy way to engage with me. Like, those sorts of things happen as a result of this activity, and it's one of the big surprises to me and joys to me that came out of that first Techstars program, which is, if you had predicted to me that 11 years later there would be this worldwide wiring across startup communities globally that had emerged from this program we'd done in 2006 or 2007 in Boulder, I wouldn't have, it wouldn't have been a construct that I would have thought of.
Yeah, and I got to witness sort of the expansion of that firsthand in Seattle in 2010, run by Andy Sack, and I think that was the third of the Techstars. And even in a larger city where, we're raising our hands in terms of, is there the money, is there the interest, just the crazy difference between 2009 and then 2011, a year after the program ran, you suddenly said all of these people were here all along, just nobody was actually interacting with each other and in my opinion, kind of investing in the future of the city rather than investing in specific companies themselves. And kind of as a transition and part of that, Brad, I'm curious, with your angel investor hat on, obviously, most of your investments are now through Foundry. In your early days of angel investing and towards the later, I'm really curious to know how your thought process evolved and how you kind of evaluated an investment and a team.
Yeah, so I've thought about this a lot because it actually now is a key part of how we invest from Foundry Group as well. I wrote my first angel investment in 1994, sold my business in November 93, made a couple $1 million. I committed to Amy that I would never have less than $100,000 in the bank. Of course, I broke that commitment, and I remember having a very uncomfortable conversation with her after writing a $25,000 check into company number, 37 or something like that, and saying, the bank balance is now $87,000, and but don't worry, it'll be okay. And she was supportive. That first investment was in a company called NetGenesis, and the company was four MIT seniors who were just graduating, led by a guy named Raj Bhargava. And they were the four people that showed me the World Wide Web for the first time. So I went to a building with them at MIT, and I looked at a thing called Freshman Fish Wrap, which was an MIT hacked together sort of daily news site. I think there were about 35 websites that were public on the web at the time, and that was one of them. I had never made an investment before, but immediately after spending a couple of hours with them, and they didn't have any idea how to put together a company, my response was, I want to invest in your company. I want to invest $25,000 in your company. Let's go figure out how to do that. In that 1994 to 96 timeframe, before I started the first venture fund, I co-started the first venture fund I was part of, which was originally affiliated with SoftBank, turned into something called Mobius Venture Capital. I made 40 investments of $25,000 to $50,000 with basically all the money that I had from that sale of that first company. And I developed a strategy over time, but my view from the very beginning was I'm investing in two things. Number one, people that I'm excited about, not people who are the best entrepreneurs, not people who have experience, people that I'm excited about. I want to work with these people. And the second was products that I had an affinity for, things that I thought were cool, things that I thought could be really important and interesting. And by the way, when you're investing at the very beginning, the simple phrase of products that I think could be cool is probably a lot better than the other way you would describe it. Like, what is the available market for any of these things? Like, I don't know. They're either zero or enormous. What's the business model? Well, in 1994, the only business models that people really understood was either selling things or licensing things. Today, there's more business models that exist, but there's still not that many different business models. And so I think a lot of investors spend a lot of time struggling at the earliest stages trying to understand that. And it's just extremely hard to do. And so I was very focused on those two characteristics. Are these people that I want to invest in? And I got to define the dimensions of that for myself. And the second is, the product that they're working on, something that I'm into. The third characteristic, by the way, that we've added into it at Foundry Group is, are the founders obsessed about what they're working on? And we use the word obsessed very deliberately. In entrepreneurship, you hear the word passion all the time. And how many people in the audience, I'm curious, identify as introverts? Okay, I identify as an introvert too, by the way. And those of you in the audience, how many of you have not read the book by Susan Cain, Quiet? Okay, I encourage everybody in the audience that hasn't read that book to read that book. It's one of the most important books, I think, about describing the dynamics between introverts and extroverts. And it was the first time as an adult that I really understood the dynamic in a way that I could talk to people about it. Passion is something that is the domain of extroverts. And when I'm feeling kind of cranky, I say it's a domain of extroverts and salespeople. And I say that I'm cranky, even though I'm an introvert. I'm a pretty good salesperson, and I spend a fair amount of my time selling and promoting the things I'm involved in. But fundamentally, it's incredibly easy to fake passion, because passion and enthusiasm get conflated often in a business context. And if you're good at selling or you're an extrovert, you know how to have enthusiasm. It's so awesome to be spending time with you guys here today. It's just like, I couldn't think of something I'd rather be doing than talking to you through the magic of not having to physically come, but of just be with you. I mean, if I could reach out and hug each of you, I would. Right? That's passion. And obsession is something very different. And it's super easy to fake passion, and it's extraordinarily difficult to fake obsession. And so we look for founders who are obsessed with what they're doing. And lots of times people use the word obsessed unhealthily, and there are definitely unhealthy versions of obsession. But there is this notion of asking yourself, if you're an entrepreneur, ask yourself this question every morning. Was I put on this planet to work on the thing I'm working on? And if the answer is no, don't go back to sleep. but go for a walk and wonder why you're doing it. And ask yourself, what about this is the thing that you've chosen to do? And as an angel investor, that's essentially what I was doing. I also have a blog post from a while ago. I think it's called Strategies for Angel Investors on Feld.com. I had a couple of other things in it. One is, and I'll say them quickly since we're on this thread. One is that you should be promiscuous. For 3 years, I made one angel investment a month. This is in the mid-90s. There was a thing called a super angel that emerged sort of in the late 2000s, the sort of successful entrepreneurs that made lots of investments. And I'm sure I wasn't the first person to execute the strategy. But as an angel investor, you have to understand one piece of math, and that's it. All of my investments were between $25,000 and $50,000 because I had a strategy around $25,000 first check, and sometime, depending on circumstances, I might put another $25,000 in. So let's say that all my investments were $50,000 just for ease of math, and I made 40 of them. I've had 3 investments that have returned over, each of them have returned over 100 times my money. So even if the other 37 investments were all zeros, I had a very successful angel portfolio. And by the way, the other 37 investments ranged from 0 to I got some or all of my money back to 2 times my money or 3 times my money, in some cases 5 or 10, and a couple of cases 25 or 50 times my money. So it's just understanding what I like to say the difference between 100 times your money and 0 times your money. And if you're like that angel investment group that I described in Boulder that only invested in one company a year, their chance of finding that company that was 100 times their money was much lower than mine. And you can do whatever statistics you want against it, but if you look at the patterns over time at the very beginning, it's incredibly difficult to identify that one company that's going to go ahead and be a success. And so having a portfolio and deciding on your level of promiscuity, a dozen a year was plenty for me. Some people 4 or 5 is plenty for them. The other is then have a budget. So have a budget that's not a year-to-year budget. I had a budget that was essentially a 3-year budget where I said to Amy, I'm not going to get below $100,000 in the bank, and that included sort of how many I was going to do. And what I realized as I was starting to have returns come back in year 3 and year 4 was I probably would have to reevaluate that budget on a regular basis based on the return characteristics. But I didn't invest a whole bunch of money in 12 months and then not do anything for the next 6 and then start investing again. It was very systematic and very paced over a period of time. And if you look at venture firms, most venture firms have that kind of a strategy, which I think works extremely well for angel investing.
So to kind of move a little bit further along that, as an angel investor, and I just think about the ones that I know, and even early stage investors as well, who are funds, a lot of times you tend to invest in spaces that you're familiar with, and then a lot of times folks get excited about new opportunities like cryptocurrency, AR, VR, and Brad, I'm curious as you look at the early stage ecosystem, what are some of the areas that you get excited about today?
Well, our investment strategy at Foundry Group is one that we describe as being thematically based. So we have a set of themes that we define. If you go to foundrygroup.com/themes, you'll see them on our website. And these are themes that we believe will have validity and be a key source of change in technology innovation over a 30-year period. So one thing that's important to distinguish between is whether you have that approach or whether you're of an approach where you're looking for something that is the next hot thing. By the way, both strategies can work, but I'm just being clear on how ours works, and we have a bunch of reasons why we think it's more effective, at least for us. As a result, many of the things today that are front and center, and I'll get to the question and answer a few things that are front and center today, are not things that we're chasing because of their hot newness, but because of how they fit within our themes. So an example of that would be clearly crypto. How many people here don't know what the word cryptocurrency means? Okay, a couple. So turn to your neighbor and ask them, because cryptocurrency is one of the hot newnesses. Do that after the talk, by the way. for those of you that know cryptocurrency and understand, I'll just define the theme. We have a theme we call protocol, and protocol are companies built around technology protocols. An example of that would be companies built around the SMT protocol, which is the protocol that underlies email, of which we've been investing in for a very long time. We've probably had 15 or 20 companies, including our angel investments, that have been companies built around the SMT protocol. We have a company that went through Techstars in the 2009 class in Boulder that we're investors in, that just filed its S1 last week or 2 days ago to go public. That is a company built on top of the SMT protocol. And our view is that that SMT protocol is going to still be durable for many, many years. How many of you don't use email? There you go. When you think about protocols, that's how we think about it. And for us, cryptocurrency is a protocol investing, part of our protocol theme. Blockchain is the piece that enables cryptocurrencies, and cryptocurrencies are a particular application on top of the blockchain. That's how we think about our world. And many of our investments, by the way, are on a theme we call human-computer interaction, which is based on the premise that the way that humans and computers interact 30 years from now will be radically different from the way they interact 30 years ago. And if you want some inspiration for that theme, I encourage you to watch The Jetsons. You don't have to watch the whole 2 years of it. Just watch a couple of episodes. And when you see Rosie the robot, you'll realize that our investment in a company called Misty Robotics is totally inspired by Rosie. And when you see the Matterport on the wall and the food machine that George doesn't know how to use, but Jane does, which just shows you the sexism in the 1960s, you'll understand where our investment in Chalbotics comes from. So, if you then wind forward and say, okay, well, that's nice, Brad, we understand your intellectual approach, but what are the hot areas today? Right? Clearly, cryptocurrencies and blockchain has an incredible amount of activity going on in it. Some of it legitimate, an awful lot of it completely bogus and specious. So as an angel investor, being really clear about what you're actually investing in at that moment in time is important. And by the way, I'm starting to feel like there's similar characteristics to what was happening in 1998 and 1999 around .com investing, which is not to say that everything's a sham. There were some incredibly significant things that came out of the .com investing cycle, as well as some huge fortunes. But there was an awful lot of it that when the internet bubble started deflating in 2000 and 2001, completely fell apart, and people lost lots and lots of money in the process. So it feels like the characteristics are the same. And when people talk about things like a crypto bubble, I think that's nonsensical. I think it's a better analogy to think about it in that 98, 99 timeframe, where it's gone from something that a relatively small number of people are putting lots of energy into. All of a sudden, it's gone mainstream. But as a result of it going mainstream, there's an awful lot of crap in the system. Apple just released a new iPhone. They made a big deal about ARKit. Facebook's trying really, really hard to get people to strap these gigantic goggles on their face and sit on the couch all day. I'll tell you, I'll strap those goggles on my face and sit on the couch once I can actually plug into the couch and let the couch feed me and take my waste away. For those of you that read a lot of science fiction, that's a dystopic vision of the future. And for those of you that are into this, the movie that's coming out, I don't know when, it should be imminent, Ready Player One, is going to be a great example of that dystopia. And I think unless they screwed something up, I think it's going to be a really awesome movie. Interestingly, sort of in the mix of all of that, this AR/VR dynamic is extremely complicated in terms of what technologies people are actually going to build on and where they're going to go. So that's an area that I think is particularly compelling. We've had this incredible resurgence of the maker movement and the DIY movement. Any of you participate or identify as makers or DIY, or have anybody in your family that does? Raise your hand. Okay. It's the equivalent of when I was a kid. My dad had a great garage, and in his garage he had all kinds of tools, which, by the way, I wasn't allowed to use any of because I cut my fingers off. But my dad used to hang out in his garage and make shit. He was a doctor, and whenever something broke in the house, he'd fix it. And My brother, who ended up being way, way more mechanical than I did, also spent a lot of time putting stuff together with my dad. This is the current version of that, but it's integrated with hardware and software, and you're seeing it in companies like the one that was mentioned earlier, Glowforge in Seattle, the rise of consumer and prosumer 3D printing, the ability of any sort of distributed activity around this so that you could be in one place and 3D print something somewhere else. So I think that's another area that's particularly compelling. I would say to be careful, though, of chasing specific areas. So I gave a talk 3 or 4 years ago. I'll end on this specific one. I gave a talk 3 or 4 years ago in Boston, maybe longer now, at a conference that Xconomy did called the Big Data Conference. And they wanted me to keynote and talk about how exciting big data was. And I got up and my opening line was, "Big data is bullshit." And I don't think they expected that. And in the context of that, I said, it's a phrase right now that's being used to label something that 10 years from now we're going to refer to as microscopic data, right? The amount of data that people are dealing with in a big data situation, if you wind the clock forward a decade, the unit of data today is going to be, in the future, a tiny amount of the data we're dealing with. I would suggest that machine learning and AI has similar characteristics. Every single software-related business plan, presentation, overview, anything that I get these days has some version of AI and machine learning in it. We're the most boring enterprise software business ever. We're building a SaaS-based company to disrupt the cash registers in the little gas station, mini mart business, and we're using machine learning and AI to do it. I'm like, the first part of that is a good business, and the second part of that just told me you just discredited yourself, because that's not the thing that's interesting. There might be an element of it that's interesting of applying those kinds of technologies to your business, but try not to get sort of confused by this, because I guess in 3 years we're going to have something totally different. I said that was the last thing. The other thing that I think is completely transformative, and this is a survey question for me. How many of you have, I can say it here because the one I have here is named something differently. How many of you have an Alexa in your home? Okay. How many of you have a Google Home in your home? Oh, see, good market share data for Amazon.
I'm bringing that back to the Alexa folks.
Okay. We've been working, technologists have been working on voice entry for 40 years. And if you go back and watch that first Jetsons, and when I talk about the Jetsons, I'm talking about the one from 1962 and 63, not the one that happened in the 80s. Go back to the very original Hanna-Barbera one. And they're only 20 minutes long. I mean, they're totally worth watching a couple of them because they're incredible. And in that you see all the family members talking constantly to the computer, and just things happening. And we're finally at the edge of that, right? I think Amazon is doing and has done an incredible job of packaging that technology in such a way to make it broadly accessible through their Alexa product line. They're expanding it at an unbelievable clip in terms of the product, the core technology, and how the core technology integrates with other things. Not surprisingly, Google is chasing after that now. Expect Microsoft to chase after that. You see Sonos just announced speakers that have Alexa integration. For those of you that have Sonos in your house, wouldn't it be a lot easier to say, Sonos, play Imagine Dragons at highest volume in my kid's bedroom when your kid was sleeping too late on a Friday and needed to get up, right? Like, just being able to do that and not have to pull out your phone and do something will change the way we all interact with computing. Of course, some Siri and if you have a Google phone, OK Google has gotten us there already, but it's a sort of broad ubiquity, and the application layer, the number of companies that people can build on top of that, I think are pretty limitless right now.
Cool. So I think we're getting close to the Q&A. Should we go to that, or one more question? I think there's one more question. Before we go to that, I think just to share a little bit on the Alexa side, obviously I get to work really close with the Amazon folks and have an idea of where they see all this going. And there's one really interesting piece of it that Dave Limp, who is essentially the guy right below Bezos, who's in charge of this whole ecosystem, and he doesn't really even refer to it as voice. He talks about it in terms of ambient user experience, where to go with what Brad's talking about. You watch the Jetsons, where the way that humans and machines interact is just so natural. But there's this important barrier where I see some of you on your laptops and your phones. I'm not calling you out saying you're not paying attention, but what you are doing is you are translating to the machine. The burden is on you to figure out how to use it, to translate what I'm trying to do into the taps. What's so amazing about voice and other interactions like that is suddenly the burden's on the machine. And right now, I'm sure with some of you with your Alexa devices, you're frustrated because she doesn't understand what you're saying. But you have to realize this is the first time that the burden's on the machine, not on you, or you're getting frustrated yourself that you don't know how to translate the input. This is a whole new way of interacting with machines. So it's something I'm super excited about, and I'll, if any of you want to geek out about that later during the day, I'd love to. So talking about Amazon, obviously, Techstars has a whole bunch of these corporate accelerators. And Brad, I'm curious, what are your thoughts on what does the future look like of these larger enterprises and startups working together? Because it's dramatically changing, but how does that kind of change the ecosystem in terms of exits and collaboration versus the previous world where, in many cases, large companies and startups were oil and water?
Yeah, I think one of the things that is both a key premise of ours at Techstars, at the same time something that we believe we have a huge expertise and competence at, and are continuing to learn and build on that, is the linkage between startups and large companies, and how to make that linkage be one that is a meaningful positive force for both the large companies and the startups. I think historically, the oil and water phenomena is not just behavioral. In other words, if you work in a Fortune 100 company, in any role, and you work in a startup, and if you've never worked in a startup, but you work in that Fortune 100 company or Fortune 1000 company, you don't understand how the startup works, behaves, operates, functions. And if you're in a startup and you've never worked in a large company, you also don't have the perspective, a generic perspective, let alone the specific perspective of that company that you're dealing with. You go a step deeper, the engagement dynamics between large companies and small companies have often been extremely toxic. Small companies have no resources. They're constantly trying as hard as they can to move very, very quickly, lots of short experiments. And when they encounter a large company, the large company often moves at a pace that's very desynchronized with the pace of a small company. And vice versa. Large companies are often used to controlling lots of things in their environment, whether it's inside the company or outside. They often have powerful market positions, and they know how to extend and expand and defend those market positions. And they might even view startups as a threat rather than something that can help them extend and enhance what they're doing. There's another dimension of it, which is that if you go back to this notion of your city, startups are an important part, large companies are an important part of your city, but so are startups. And historically, there's often the case that the large companies don't really understand or are afraid of investing energy and resources in and around the startups for a variety of reasons, including the most stupid one, which is that their employees will leave and go join the startups. Instead, what we're trying to do, and I think what we're accomplishing in lots of places, and I'll give a short example, is the linkage between startups, the large companies, and the startup community can be incredibly constructive, vibrant, and positive for both. And I just had a massive, massive dose of this in Atlanta. The Techstars Atlanta program is done in conjunction with Cox Enterprises, which is a very large, I think $25 billion revenue, family-owned business, private company that's based in Atlanta and is one of the key companies in Atlanta. And they made a conscious decision to invest energy, time, resources, and money in the Atlanta startup community. One of the vehicles is through Techstars Atlanta. And it's really, like, just even the words are valuable. They didn't call it the Cox program or the Cox Accelerator. They chose to call it Techstars Atlanta because they actually were focused on the engagement with the broader Atlanta community. Now, that's not a negative on a program like the Alexa Accelerator, because the Alexa Accelerator is in Seattle, which also has a Techstars Seattle program. And the linkage between the two is very powerful around the notion of ecosystem, both in the community and around Alexa. And so they have different motivations, right? Cox wasn't focused on building startup community or startup activity around their businesses. They were focused on the geography. Amazon was focused, I think, primarily on Alexa and secondarily on the geography. So it's understanding how, as Techstars, working with these companies and understanding how to help them accomplish their goals, where that interface still is between the large companies and then the startups that are around whatever their ecosystem is. Again, in Alexa's case, it's an ecosystem that's not geographically based. I don't know the number of Seattle-based companies that went through the Alexa Accelerator, but my guess is the proportion was lower than the number of Seattle-based companies or Pacific Northwest-based companies went through Techstars Seattle, right? So it's in Techstars, we don't have this dogmatic view of this is what you as a large company should do for your innovation economy, which I'd suggest there's lots of consulting firms that are, the McKinsey, Bain, BCG ilk that do consulting on with large companies around innovation. That's not our view. I'm going to come back to something somebody else said. It's engaging in the activity. It's what Seattle looked like in 2011, because all the entrepreneurs who were doing stuff now all of a sudden knew about each other and were working with each other. And wouldn't it be even more amazing if you could link the large company or the large companies in your city, in your community, into that activity in a way that people actually work together versus had either hypotheses about what the other was like or just avoided dealing with it. That's part of what we've learned from it.
Thanks, Brad. So I think with that, we're going to transition over to all of you to ask some questions. And we've got, how are we going to?
We're going to use the catch boxes like we did earlier. And so we have one on this side for now. We're looking for the other one shortly. So anybody on this side have a question right away? I know Julie's got one over there. Maybe we could get it to Julie. A long throw, and we'll see if Julie can catch it. There you go. Oh. This is it. Oh, I wanted to see Julie catch the long throw.
I know. I will. Throw it. Where is it?
Oh, God. Oh. This is the best and worst invention.
Is it working? Is it working?
Yeah.
Hey, Brad. Julie Harrelson with Cascade Angels. I really appreciated your comments about funding the innovation economy, but I wanted to shift the topic a little bit. So what insight might you have for those, say, couple hundred of us in Bend and Central Oregon that are driving this nascent ecosystem in terms of the value of self-awareness when you're kind of an obsessed personality, and in terms of that drive, what things have you found useful in terms of being a leader and being self-aware?
A couple of quick ones. Number one, be inclusive. Just be inclusive of everyone who wants to engage no matter what, and listen. Today I'm doing a lot of talking, and I talk plenty. Amy likes to tell me that all my stories are 20% too long, and I try to tell her that at least they're only 20% too long. But listen to everyone who is engaging with you or that you engage with so that you get lots of different inputs as a leader. One of the mistakes I think that leaders make often is that they get inputs from a finite number of people. And in the notion of making a robust startup community, those inputs are important. And if you go back to the Startup Community book, it's the third tenet in the Boulder thesis is be inclusive. The next is recognize you're functioning in the context of a network, not a hierarchy. And for people who, I'm going to key off of this notion of being obsessed about what you're doing. For people that are obsessed, sometimes, not always, but sometimes the behavior manifests itself as control. Right? You have this view that a certain thing has to happen, and that thing, you got to get that thing done, and to get that thing done, you have to behave a certain way, and you have to focus everybody on a certain thing. And the challenge is that may work in a single organization that has a single focus, but the startup community doesn't have a single focus. It's this distributed network. And so what you're doing is you're being obsessed about the thing or things you care about, but you have to not be obsessed about them to the exclusion of others. You have to be obsessed about it in the context, again, of the inclusion of others. The last, and this is super hard, and politics as a backdrop just reminds us how hard it is, right? We're all human beings. I like to say we're all big bags of chemicals. We have different frames of reference. People behave in different ways. They come from different perspectives. The characteristics in different communities vary widely around aspects like privilege, aspects like gender, or even aspects like gender identity in some communities. In the context of startups and the startup activity, again, acknowledging and understanding those differences, and trying not to exert behavior that would be construed as negative in the context of that is key. So here's an assignment I often give people, which I think is a fun one, and it's a really hard one. And if you want to do this, write it down and try it, and decide to do it for a week. Every time you refer to an entrepreneur using a pronoun for the next week, use the pronouns her or she. Every time you talk about a leader or a CEO for the next week, use the pronoun her or she. It is really hard. And you will see if you then just listen to people, they will often use he or him as the pronoun as the default. So they use he or him as the default. Why wouldn't we use her and she as the default? And it's amazing when you change that. It's amazing when you change that, how it changes the tone of so many conversations and people's ability to interact at a different level. Just because you're causing there to be a pause on a dimension that in our world of entrepreneurship is still a problem. And it's not just a problem at the sexual harassment level, it's a problem at just this notion of gender equality and the fact that gender shouldn't be a dynamic, shouldn't be pejorative, so I'm not going to say that. Gender as a dynamic in the mix is in a place that is inhibiting of individuals, of startup communities, and of the network dynamic. So, try things like that. And put yourself in a place that's not comfortable. And by the way, I gave a talk yesterday, just as an example. It's really, this stuff is hard. I gave a talk yesterday. We have an off-year election in Boulder for city council and local stuff. Every odd year we have our elections. And, I gave a big talk to a group of, 150 people, all who were interested in sort of the future of Boulder, many of which were people that had been in Boulder for 5 or 10 years, a lot of people who were in their 20s and 30s. And I made a comment, and I think the comment I made was, the future of Boulder is not only in the hands of 50-year-olds. I'm 51, right? And the message I was delivering was the future of Boulder is in all of our hands. And we need to get the people who are 20 and 30 engaged because they need to have as much influence as I do and the people who are 60 and 70 in the future of Boulder. And not surprisingly, it got misquoted and said the future is not in the hands of the 50-year-olds. I might have said that, by the way, but that was right. But that was in the context of the longer statement, right? So I didn't pick my words super carefully. But if you heard the longer statement, you heard that what I was saying was it's in everybody's hands, and we have to work on the whole spectrum. And predictably, all of a sudden, I'm being called an ageist, and everybody's saying to me that the disgusting ageism demonstrated by the progressive, real estate developer type people, which I'm not one of, in Boulder, right? So it's hard to get right because people have these reactions to it. And as obsessed leaders, work on that stuff too, because that stuff is the stuff that will make you have a really robust long-term dynamic in your community.
Thank you.
Hi, so for those of us who cannot financially be investors or don't want to be entrepreneurs, how can we either as individuals or through our institutions contribute to the startup community?
Awesome question. The magic trick is to recognize that your time is probably worth more than you writing a check. So just start from that premise. And anybody that feels like the money is more valuable than time, I encourage you to reverse that. The time is what is valuable. The second is that if you work for an organization that wants to engage and can engage and be involved in the startup community, function from the following perspective. Number one, your organization, no matter how big or small, is probably hierarchical, right? You have a boss, and I like to say the way that you make progress up your hierarchy is you either do an exceptional job and get promoted up the hierarchy, or you undermine your boss gets fired, and you get promoted up to take your boss's place, right? And so for those of you that have worked in large hierarchies and you think about dysfunctional hierarchies, that second statement probably rings true. The first statement is the optimistic view of a hierarchy. That's not how it works in a network, which is what the startup community is. And so in the startup community, you have to just function with a different frame of reference than in a hierarchical organization. The magic trick, if you're part of an organization, is instead of trying to control the network, instead of trying to apply your organization structure and values to the startup community in some way, the better thing to do is for an individual, for you as the individual, representing to your organization. So it doesn't have to be you separately from your organization, but connecting in as a node on the network. So you have to embrace this notion of that you're participating in the network as a node, and you're bringing the resources and values of your organization and the motivations, right? Your organization, you got a motivation as an organization. That's totally cool. But you're doing it by participating and engaging in the startup community through this network model, rather than the idea of trying to control it from your organization. You'll hear this around Techstars all the time, a phrase called give first. In the book Startup Communities, I have a small section called Give Before You Get. And one of my next books, come out next year, is called Give First. It's a cousin of Adam Grant's amazing book, Give and Take. If you haven't read Adam Grant's book, I encourage everybody here to do it. Adam's a Wharton professor that wrote, I think, one of the most influential books, at least from my frame of reference, in the last 4 or 5 years. And he basically, from a research perspective, shows that people that give more versus people that take more, the people who give more are not just more happy, they're also more financially successful over the long term, and they're more functionally successful over the long term. In the notion of that, the idea of give first is put energy into the startup community without defining upfront what you're going to get back. It's a non-transactional relationship. It does not mean that's altruistic. You do expect to get something back. You just don't know when, from whom, over what time period, in what type of consideration. It could be money, it could be Bitcoin, it could be chickens. I don't know. That you're going to get back, and in what magnitude. And my premise, and a big part of the premise of Techstars, is if you can get everyone in the startup communities giving and putting energy into the startup community, you get a flywheel going that over a long period of time generates magnificent and incredible things back, far in excess of the energy that went in. And that's the best way for organizations to engage with the startup community. It's try to become a node on the network. Don't control things as an individual, not an organization, but representing your organization. Participate rather than control. Bring the resources of your organization to the startup community and continue to do that over a long period of time without defining upfront transactionally what you expect to get back. And it's really, really powerful when those things start to click.
No? Oh, there we go. Brad, thanks very much for doing this. I'm Scott Sandler with the Oregon Angel Fund. Love your blog and your book recommendations. I'd like to ask about something back from the beginning of the presentation where you mentioned that entrepreneurs have some responsibility for helping investors learn how to make seed and angel investments. I'd like to ask you to elaborate on that responsibility and how they might approach that.
Sure. And remember, it's in the context of entrepreneurs. You know, pick your word, complaining, whining, being frustrated that there's no money available here. There's lots of ways to do it. One of the most significant ways to do it in cities that I've seen is to actually do a startup week. And Techstars now runs Startup Week. It used to be part of an organization called Up Global. And I think there's a startup week every week somewhere in the world. And if you look at actually the Denver Startup Week just happened, and I think there were about 20,000 people participated over the course of the week. And what you have in that is you have a structure to get people who are wealthy and interested in what's going on, understanding that the startup community is an important part of the community. And then in the context of that, not just having a 2-day event or a 1-day event where you're trying to educate people how to be angel investors, but again, the same kind of thing, having some of that mixed into a bunch of activities to allow the entrepreneurs and those new investors to engage in what they're doing and understand it. I would suggest, for example, if you took this entire group of people, some entrepreneurs and some investors, and you decided to do, it doesn't have to do a full week, you could even do a mini week, or you could do another version of this, where each of you brought 2 people from your network that were high net worth people or wealthy people. And when I say wealthy, it doesn't have to be massive amounts of wealth, right? Somebody who could write a couple of $25,000 checks a year. And you figured out a way to have even a short unconference around this activity. All of a sudden, you're getting new people into the mix. Whenever an entrepreneur says to me, I don't know any of those people, I often say, look to your left or look to your right. And it's, the woman who said, I don't have the resources to invest personally, my guess, and I could be wrong, but my guess is you probably know some people who do have the resources to invest personally. And part of what you can do to be additive to the startup community is to get them to show up and participate in something. Find somebody who is an active angel investor and have a small dinner with them where you're convening the dinner with a couple of friends of yours or people in your network or through your organization with a couple of entrepreneurs and a couple of active angel investors to talk about how and why they can do it. So I'm giving you a spectrum of things from an organized thing that you can build a framework around to, at the other end, literally those kinds of small groups where it has to happen continuously. How many people in this room are angel investors? Just raise your hand. How many people in this room have written at least one $25,000 check in the last 12 months? Okay. How many of you have hosted a dinner with 1 or 2 entrepreneurs and at least 1 or 2 other people who are in your network that you know that have resources that have not made angel investments? How many of you have hosted at least one of those dinners in the last year? How about one of those dinners every quarter for the last year? And how about one of those dinners every month for the last year? Okay? So one thing that I would do, awesome, yay, right? And by the way, yay for all of you who did it once in the last year. Do more of it. And because you have angel investments, tell the entrepreneurs you are working with to be the ones to help you host and convene those dinners and to invite different people. And just don't invite the same ones. And set an email list up that's Ben Angel Investor, Gorilla Angel Investor Ben. Not Gorilla the ape, Gorilla the not organized. And set up an email list and start adding people to the email list so you get more connections to other people. Don't be organized about it, be network driven about it. And it doesn't mean don't do the organized things too, but from the bottom up, make that happen.
Thank you. And I believe that was our last question, so that's a wrap. Thank you, Brad, so much for being with us.
My pleasure.
Thank you.
Yeah, absolutely.
All right. See y'all later. Have a good rest of conference.
That was faster than I could say thanks from everybody here at EDCO and from Ben. But thank you. Appreciate it.
Pleasure being here.
Great. That was awesome.